I say to anyone who is new to impact investing that impact investment is just like any investment, but another lens to it, which we call an impact.
Impact can mean many things. It can be environmental impact and social impact. And there has been a lot of discussion that how we define impact that has been very much not consistent or not very, unified.
Welcome once again to Money Meets Mission, brought to you by AVPN in association with Tech for Impact. This is episode 3 in our series, and today we'll be talking about impact investing. It's a term that's becoming increasingly familiar on the Asian finance and sustainability landscapes, as more private money is being diverted towards projects that contain within them some degree of, impact. But what does that mean? What does it involve? What are its aims, and how can we tell when it's working? For answers, I spoke to 2 impact investment practitioners with long experience of the sector. Murray Kogiso is the co-CEO of SDG Impact Japan. Kim Wonyoung is co-founder and managing director of Kogiso Partners in Seoul. And you can find their full bios and backgrounds on the Money Meets Mission webpage at avpn.org. I began our conversation by asking, what is impact investing?
I think impact investing is a really evolving concept. It used to be quite narrow when we started working on impact investing. It is about 10 years ago. It was more about the private equities or not really public asset. But right now, anything that has impact are kind of called impact investing. But it's a great that there's a bigger market and more people are looking at impact investing, but at the same time it's a definition of impact investing becoming a little bit more unclear. I think that it's maybe a good idea that we go back to the definition of impact investing, that I believe that impact investing is investing not only looking at impact but also returns, and it has a creating impact as its objective, and also having impact measurement and management concept. So this is a basic definition of impact investing.
It's very interesting that both of your company websites have very different language to what I certainly have become used to during my life in the financial world. You talk about values in terms of social value and well-being and diversity. Wonyoung, what does all of this mean to you? And is it possible, as some have said, that it's all a little bit vague?
Yes, Teymoor. I do get that question a lot. What is impact investing? And is it just some marketing terms, or isn't it vague? I guess it is true that it's not very clear to define what impact investing is. But I think the same for what venture capital or what venture investing is, right? So how do you define from a venture company to a non-venture company? It's not a very clear line there. If you see in the history of how impact investing evolved, there was something called ESG investing, or sustainability investing, or sustainable responsibility investing. So SRI is usually an investment that is made to a company that is doing efforts to reduce negative impact of a company, while impact investing is an investment that is made to a company that is actively or proactively creating either social or environmental impact.
The interesting distinction that you made between what in the old days used to be let's avoid doing anything bad to now we're getting much more into a conversation of let's be doing something proactively good. And I want to get into how we can actually define those more precisely. But the vagueness, it seems to me, is gradually being whittled away. Because we're not just talking about, okay, let's do something good. There are definitions, there are regulatory considerations being brought in. And specifically, in Europe, we've got sustainable financial disclosure regulation becoming very much part of that conversation. And I think it's something that you've built into your approach as well. So tell us what those considerations consist of and how you are bringing them to bear.
I think it's a great progress that has been made in Europe by SFDR. So what they're doing is by setting their EU taxonomy. So they're basically defining what impact means, because impact can mean many things. It can be environmental impact and social impact. And there has been a lot of discussion that how we define impact, that has been very much not consistent or not very, unified. There has been a lot of progress and many evaluation institutions are now talking. And of course, big thing is, as you said, that European EU taxonomy is coming up to define what is impact. So one of the, regulation that they have introduced this year is a distinction between so-called Article 6, Article 8, Article 9 fund to avoid SDG washing or ESG washing. And what they kind of try to define is they try to define if that is the fund that looking at ESG consideration or having ESG consideration but not having impact as one of its objective, or creating impact as one of its objective, which is classified as Article 9 fund. So what we are now...
Sorry to interrupt. Just to be absolutely clear about what that is. I mean, Article 6 basically is you have nothing to do with impact investing. You're not an impact investor. Articles 8 and 9 have slightly finer definitions of what it means to do impact investing. Within that, I think your approach has been to go for Article 9, which is the most concise and the most precise definitions and expectations. But what does it mean for you in actual practice terms? Tell me, when you're looking at investments, what does Article 9 bind you to, and what is it that you think you're delivering for a retail investor who says, I'm looking for the best product here?
Right. I think as just Wonyoung said, the difference between Article 8 and Article 9 is if it's really looking at positive impact being created by this fund. That is how we can define that the fund has creating impact as its objective. So that need to be measured and that need to be defined. But current situation is lots of ESG fund is having the methodology called ESG integration, which is having ESG as one of the evaluation or tool to evaluate when they kind of select the portfolio company, but not necessarily really measuring the impact that has been created. So the difference between Article 8 and Article 9 is if you really define the impact clearly and measure it, or having active activities to create this movement. So for our fund, we have a very big, engagement portion that we are not trying to define and measure, but we try to work with company to create the impact. We evaluate the company, and if the company has some problem with human rights, we try to work with company to improve that. And we believe that we can improve the return profile, not only impact profile by doing so.
Wonyoung, does that EU methodology, that framework, make sense to you? Is it something that you filter in and factor into your decision-making process?
Definitely. One thing I would like to add is, in order to understand the difference between an impact investment or SRI investment or any commercial investment, is actually the company, the deal that you're investing into. So for example, if you're investing into a company, let's say that the company provides peer-to-peer lending services to low-income people, then in that case, this company provides their services and create revenue. This company will create more impact in the side of the beneficiaries by providing productive loans so that these people can use those loans to create income. So when we are dealing with the actual practices of making decisions, whether to make investments or not, we really have to understand the deal and their business model, their structure, and their value chain, and how their input is converted to outputs and in the end into outcome and impact.
We'll get into the precise details of how you assess these things in a minute, Wonyoung, but I just wanted, for a final question as we examine the broader ecosystem, how do you differentiate what you do from what the rest of the impact investment market does, from what Marie's approach to these whole things is? And do you think that the evolution of these differential elements is going to continue in the broader market as more and more money starts targeting impact investment?
Yes, impact investing can range from below market rate to above market rate. It can be in the form of venture capital, or it can be in the form of private equity. It can also be in the form of course, venture philanthropy. What we do in the impact investment scene is we are more venture capital approach. So we like to look for companies in early stages who have a very innovative technology and a very clear idea how they can use those technologies to create impact. Another approach that we have is blended finance, where we would like to bring the private capital and also the grant or the concessional loans together to create impact to the companies.
Blending the different elements for a different outcome.
Yes.
But just define for me very quickly and more precisely, a venture approach to impact would appear in many ways to be inherently contradictory.
Well, I think differently, because in order to create an impact, you need innovation. And this innovation usually comes from technology. So without the technology, there can not much be of an innovation. And without an innovation, it's hard to create a social or environmental impact. So the more we look into these companies with technological innovations, that we see a high chance of these companies actually solving problems with the better services and products, or even with lower expenses or costs, meaning that they can provide the same service or better service to their customers.
Marie, one of the points Wonyoung made there was the suggestion of returns as being a factor in the consideration. And that's why I sort of put that point about venture and social impact, because, you know, in the popular conception, venture as a term, as an investment term, is normally associated with, for want of a better term, predatory activity, prioritizing profit over anything else. And that's where I saw perhaps an inherent contradiction. But you tell me where your view is in terms of your approach. Where do you fit upon that spectrum that Wonyoung identified there? Are you to the venture side? And tell me how you think about how that spectrum plays out.
Right. Well, actually, we work on both funds. Like we have ESG impact fund, which targeting, which investing in a public company, but we also work on a venture impact fund. And we are also looking at technology. So I very much echo with what Wonyoung said, because like, investing in, impact has been seen as trade-off was returns, and the impact has been trade-off. But I think that trend is really changing, because even the public company, they don't see ESG as a risk or a cost anymore, because it's something that they have to deal with. And to deal with, they need innovation. Like they need a new way to work on to create new market, to look at both return and sustainability at the same time. So this is a shift that I'm looking very much not only in the venture world, but even with public big companies that are more looking at innovative way and different way using AI or technology or blockchain, or kind of introducing a new innovation to meet their sustainability goals.
How do you think the industry is going to evolve, Marie? A few years back, as it's been developing, most of the money that was going into so-called impact investing was coming from the developmental financial institutions, the big institutions, not really private sector money. Now we're seeing a lot of private sector money coming in, and most of it seems to be going into big projects. I mean, we're seeing very little at seed stage. We're seeing most deals above $1 million and more in terms of financing. You see the architecture, if you like, or the elements of the industry beginning to change from those basic that basic framework?
Well, I think that there's of course, risk appetite of big corporation, right? So especially like Japanese corporation is very, very conservative. So if they really kind of going into venture or more riskier like investment because it has impact or not, I'm not very sure about that. But looking at how the money is flowing into the tech sector and the new like venture sector, I think of course like there's a need for new like technology and the new development. So like maybe it will not change in like 1-2 years, but we are obviously seeing the beginning of the change. And like one example might be there's a lot of like green bond or sustainable bond coming into market. I think these products are much closer to impact concept than public equities, but they're really flowing more money into those like new invention. So there would be more direction being created even by big company or whole sector.
Would appear to be a growth area too. But from the perspective of how that market begins to evolve, do you see a change in the characteristics? And you mentioned a moment ago philanthropy. Do you think that we're going to come to a stage where some of these impact funds are going to start crowding out the philanthropy sector and the non-profit sector?
Yes. Well, before I get into that, so one of the visions that I have as an impact investor is that maybe in the future, like 20, 30, 40, 50 years from now, we'll call what we call enterprises, financial enterprises, and what we call social enterprises, just enterprises. What I mean by that is the concept of enterprise will change in time, where considering either social or environmental impact becomes something very natural for the corporations to pursue. And at the same time, one of the things that I observe in the impact investment scene is that there are traditional impact investors who currently in the past defined themselves as, impact investors. But now more and more investors are coming in from the commercial side, also taking in part of the impact investment as their either fund strategy or either in their portfolio. So I think this is a very notable changes that's happening in the market. So now there's less and less boundaries between impact investors and commercial investors. It's like now impact investors are also looking into many tech companies, and at the same time, these commercial investors are also looking into many impact companies.
We've been skirting around the issue a little bit of returns, defining and securing market returns. Murray, there's a very prevalent narrative in the market these days from a lot of people calling themselves impact funds, saying that impact funds return as much and often more than ordinary funds. Do you think that's the case? And if it is the case, why do ordinary funds exist at all? Because it would seem to be slam dunk. If you can get impact and better than market returns, then why isn't everybody doing it?
Yeah, there's a lot of argument in the market, right? Or discussion that if the ESG fund, create more profit than, non-ESG fund. So ESG fund has been doing really well in the last few years, really outperforming the current fund. It changes depending how which period you take. I think the result can vary, and the result can also vary depending on what product and what kind of area industry you are looking at. So it doesn't really make sense to just have a very, yes or no answer. It's impact investing is very broad. And especially when you said impact investing, it can be very impact first, or it can be very profit first. So it's a perspective, broad perspective, not only binary concept. I really think that people should really understand that anything creating impact is now called impact investing. It can be something like charity, very close to charity, or it can be something very close to just commercial return. So for me, it doesn't really make sense to discuss that impact investing creating more profit or not anymore.
What are your thoughts on that, Wonyoung? I mean, it's easy to talk around the subject, but like I say, to a lot of people who aren't very well versed in it, it's a very simple binary. If you can make more money in impact investing, given the prevailing climate crisis, why isn't everybody going into impact investing rather than investing in fossil fuel?
Well, to begin with, I wouldn't say every impact investing will make more money than the commercial, traditional investment. Again, in the range of returns that impact investments make in different asset classes, there are impact investment that targets above market returns. But however, at the same time, there are, of course, impact investments that are just targeting market return or below market returns. So I said that it's hard to say that every impact investment makes a better returns. But at the same time, what I want to say is there are impact investments that make a good above market return investments too.
All right. So for both of you, where is the line? Marie, tell me, what's the balance between impact and financial returns that you're trying to strike?
I would say that it really depends, right? Because if you look at the short term, many people might say that really focusing on the short term, like market situation or demand and supply, all these things makes sense to create return. But if you look at the longer term, look at the climate or look at social situation, you never can say that at this point, impact investing will not be creating as much as return. Like looking at the situation evolving, like social climate situation. So it really depends how you define investment finance. But as Wonyoung said, that as a proponent,
I'd like to know how you define.
How I define return and impact.
Yeah. You said it depends on how you define it. So I want you to be specific about your position on this.
Oh, okay. As a proponent of impact investing, I want to echo Wonyoung that impact investing should be creating much more return in the end, because if the companies don't exist anymore, they cannot create any return, right? So, if we look at the longer term, and I think that impact investment have a very important role. And people, as you said, that people should be really looking at impact investing as their choice for a longer term investment.
So Wonyoung, for you, where is that balance between the impact and the financial return, and how do you present the balance to the investor? I mean, how do you sell the idea here that you're getting X amount of return, which is fairly easily quantifiable, but how do you demonstrate the value of the impact side of your offering?
Well, first of all, I would like to say that instead of looking for a balance between impact and the financial return, which of course seems like they're on the other side of the scale, but what we are looking for is integrated return, where financial return and impact comes together. So we're not saying every business is in that structure, but there are many businesses out there. Again, like I said earlier, where more the revenue they create, the more the impact is created. So that's where we come in to define that.
Sure, but is there a point when you're looking at a potential investment and a company that is in a business, an industry, a process or a product that has sustainability characteristics and environmentally friendly characteristics and a financial profile, at what point do you decide saying, okay, the financial return isn't quite great enough because they're spending too much time focusing on the environmental side of things? How do you weigh up the case in individual situations?
Very good question. So again, we think that impact investment is a process. So it's not a single evaluation or criteria that we see, oh, that's an impact investment. It's not. So we go through the due diligence processes in our venture investment life cycle. And then while doing that, we look for are they targeting the right type of or specific type of SDGs? Do they have indicators that can measure and manage their impact? Is the company really focusing on impact? Is it written in their company's business plan, or is it written in their company charter or registration? We have interviews with the CEOs or founders if they are just saying that they are pursuing impact, or do they really mean what they mean? So through the whole processes, while making the investment decisions, we look at different aspects, and while doing that, we have more and more confidence on the team, whether the team is making an impact or not. So So I wouldn't say that we look at a single indicator or a single index or a single, criteria and say, oh, that's an impact company. That's not. It's hard to say that.
Marie, the way that Wonyoung is talking there makes me think about what we were talking earlier on about the European regulations. The European system is very much focusing, at least for the moment, for the time being, on issues of transparency and disclosure. And Wonyoung, as he was saying there, so much of what you guys do is to look for that as demonstration of intent and purpose. But what about the other side of that equation, which is after you've made the investment 2 years down the line, 3 years down the line, and you're assessing the return? How do you assess what that impact has been? Because, like I say, you can measure the profit fairly easily. How do you measure the impact of the attitude towards the ESG criteria?
I think that is still very much evolving. I think there's certainly some indicators has been created, and it's becoming more and more consistent globally. Like for example, there's SASB and the IRRC has been merged, and also there's been TCFD is becoming very much a norm when it's coming to climate. For Japan, I think that the new regulation has come in that all the public company going into so-called prime market, which used to be the Tokyo Stock Exchange first category, will need to work on TCFD. And as more participants work on the same standard, there's going to be a consensus in the market, which they should be looking at. And I think that great part of TCFD is it's not just looking at indicator. It's looking at scenario analysis, and it's also looking at story. So I wouldn't recommend that just looking at indicator and waiting for indicator, but the corporation, everybody need to develop their own path, like how they reach to their impact, like what their materiality, how they should, look at this sustainability, not as of course, CSR, but as a business, because that's what they need to do.
But Wonyoung, I mean, this is the problem, isn't it? There are so many bodies, there are so many acronyms, and there are so many different assessments for the general public and for the industry as a whole. Surely we need more precision. We need better metrics to use. Are we getting to that point?
I think we are. So I've been in this scene for more than 10 years now. So for the time being, what I see is that now we have something called UN SDGs as a common consensus to set our goals as an impact investor or as a company. We have now something called IMP, Impact Management Project, where it helps you provides a framework to define impact. We now have something called IRIS Plus, which is basically a catalog of indicators how to measure these impacts. So now we have these frameworks and tools that we can work with that other organizations or institutions are also using. So that is sort of coming to a consensus in the scene. And at the same time, one of the things that I see that is also happening within our company is when we make our investment decisions and we actually make the agreement with the company, we do ask them to provide us with impact reports. So it's just like any investor would request a financial report to be submitted. We are asking these companies impact report to be submitted. So I think these are very strong evidences that impact is not just a marketing term or it's a jargon, but what is actually happening in the practice.
All right, let's finish off with a couple of predictions, if we could. Marie, where do you think the biggest gaps are that need to be addressed and where most attention is necessary in the coming years?
I think that market has really changing and there's a lot of bright aspect, especially I see that lots of so-called Z generation is more looking at investment, not just creating profit, but to create impact. So I think the whole concept of impact investing is now really changing. But the biggest gap is still, if I look at the market in Asia, there's a lack of human resources who has been really working on impact, but also understanding financial market. So there has been a huge gap between social sector and the financial sector. And now it's really coming to more like close and it's really starting to merge, but we need more people who's understanding both sector and who can really like, develop a new product or a new concept of impact investing.
And just very quickly, as we talk about, the difficulties in defining and being accurate about what they do, maybe one way of elucidating a little bit and making clearer what this market is about. Tell me the difference between the way you approach this business and the difference between the way you think Wonyoung approaches this. From this conversation that we've had, can you identify qualitative and philosophical differences in your approaches to this?
Well, I'm sorry, but I really kind of echo almost everything that Wonyoung says. So I think we are very much similar because I also work in the public market product, but I also work in the venture product. And we are both looking at technology, which we think that really important. So I don't know if you can use this part in our all. But can you think of anything, Wonyoung?
Well, let me speak on the terms of the challenges that we have. So, of course, compared to the traditional commercial market or commercial capital market, impact investment is still young and new, meaning that we still need a lot of advocacy about impact investing. We need many funders, LPs, who are willing to actually put their money into this impact investment as well. And also, because investment, we don't necessarily just mean equity investments. There can be loan investments. There can be grant investments. So different organizations coming from different background, like either DFIs or either foundations or government bodies or VCs, PEs, I think we need to work together in order to find a way to create a better impact and make the money flow from, let's say the existing traditional commercial market to the impact.
Okay, fantastic. As a final parting thought, do you think that we will reach a stage eventually when the impact sector does become bigger than the non-impact sector?
Well, I think it's going to actually combine. It will come together. So there will be a point where we're not going to distinguish between impact investment and just, investment. It's just going to be investment. It's just like we are saying that there's different industry investments, different asset class investments. It's going to be all combined into an investment basket.
Marie, do you agree with that? We're going to see a global awakening to the value of merging these ideas?
I actually totally agree. It's not only happening in the investment, but it's happening in any economic activities already, right? Company operate. They have to look at sustainability aspect, not just, not just return. So it's already, happening that, there's a less and less gap, between impact and non-impact product. It's already quite merging.
All right. Fantastic. It's been a pleasure talking to both of you. Thank you very much indeed for sharing your thoughts with us on this episode of Money Meets Mission, and best of luck in the impact sector.
Thank you very much.
Thank you very much for inviting us.
We'll see you on the next episode of Money Meets Mission. Bye-bye.